Today, I'm having a discussion with rockstar mortgage professional Toni Carter from Goldenkey Home Loans as she dives deep into the affordability issues, why lenders ask for 20% down, what's behind those PMI payments, and the different down payment assistance programs that can help you buy your first or your fifth home. You don't want to miss this.
Thank you for having me on. I'm happy to be your inaugural guest this afternoon.
Well, I want to respect your time because I know you're super busy right now, and that's kind of the segue. So we know interest rates are uber low right now. So we got a ton of buyers that are jumping back into the pool, people that are jumping into the pool for the first time, a bunch of homeowners looking to refinance right now. So I'm pretty sure your slate is busy. And as we talk about that, just for kind of, let's talk about California because that's where we're at, right? But we know all around the country, there's this real big affordability issue. What are you seeing on your side as a lender for people who are going through these type of things?
Great question. So typically what happens is on our end as a lender, before the client gets to you and you're out looking for property, we're here to assess what their current income is, what their debt is. So really no two files are exactly the same. You have borrowers that make the exact amount of income, but depending on what their debt levels are, it's going to affect how much they can afford. Now, the right now we just saw in, I think, September, home prices here in California have continued to increase despite COVID. But what's happening is over the past 6 to 8 months, the pool of buyers has shifted. So those people that have the jobs that are a little bit more stable have continued looking and been in the market very aggressively. And of course, as we all know, Los Angeles in particular is a hot area where people are constantly moving. So when it comes to affordability, the gap seems to be widening a bit because you have those people who, you know, different industries, not just one particular industry, but the pool that are able to afford something are out there aggressively making offers. So the biggest thing is the average income here in Los Angeles County is anywhere between $65,000 to $75,000. And with that particular income, it's very hard to purchase a house in that $600,000 range. So it could be multiple incomes, you know, whether it's a husband and wife, boyfriend and girlfriend, two borrowers coming together. You even have opportunities where a parent might decide to co-sign on the property for you to help increase your buying power. But the key really is to keep your debt at a minimum. So back when our parents, you know, were purchasing homes in the 70s, 80s, that was what the standard was. It was putting 20% down. Pretty much the only option was a conventional loan. Well, things have changed over the last 30 to 40 years when you have investors, Fannie Mae, Freddie Mac, all FHA, everyone changing their programs, modifying them over the past few decades, but you can purchase a home with as little as 3% down or 3.5% down on an FHA loan. Now, there's caveats to that. And what that means is we open up a can of worms when we start talking about PMI, private mortgage insurance, when it comes to putting less than 20% down. And to keep it very simple for people to understand, when you're putting 20% down, you're putting a lot of it, you're investing a lot. So if you're buying a $600,000 house, you're putting $120,000 down. So the risk is less for an investor, a bank, who's holding your note, because you have $120,000 in, they have $480,000 when it comes to that loan. Well, if you're purchasing, you know, a high-end property at $500,000, you only invest 3%, which is $15,000. There's more risk. There's more risk for that lender. So what they're doing is they assess or add on basically something called private mortgage insurance or mortgage insurance, which is really just a insurance policy for them that helps just in case you default. So I want everyone to really keep this in mind, because a lot of times people automatically see your mortgage payment and they say, oh, I don't want to pay PMI. PMI is used as a tool to help you purchase a home. It's not a forever debt. It's not a forever payment. So if that 3% that you've been saving for a long time gets your foot into the door of home ownership, you will have PMI. It is on your loan. It is on that particular loan for a period term. So if it's an FHA loan, it's on there for the life of the loan. It's if a conventional loan, it's on there until you reach a certain amount of equity. However, if you are in a property that either it increases in value, or if you've paid down your loan to a certain point, that will actually be removed. So here in Los Angeles, I'm using Los Angeles as an example because that's where we're based. If you're here in Los Angeles, property values tend to increase a lot quicker than they would in other counties than other states. So
Absolutely.
I mean, and this is not for every person that purchases a home, but some real life examples. I've had borrowers purchase a home in 2018, and hypothetically they paid $400,000. Within 14 to 18 months, their properties have increased dramatically. Inglewood in particular, or certain areas where it's in properties in high demand, those values are increasing, and borrowers have been able to remove the mortgage insurance altogether. Again, it's not a guarantee. I can't tell you that you're going to lose it, but even in my own personal purchase, it did happen where my husband and I purchased our home and we only had our PMI for about 18 months before we were able to refinance and have it removed. But it is a tool to get you into a home. And I actually want to add something to it. Mortgage insurance is tiered based. So the higher your credit score is and the more money you're putting down, those mortgage PMI rates are fluctuate. So if you were to put in 3% down and you have a 700 FICO score, your PMI rate is going to be less than a person with a 660 FICO score, because again, it's risk-based pricing. If a person were to put 10% down, you're going to have a little bit less of a rate than a person only putting 3% down. Again, it's risk. So the closer you get to that 20% mark, you're going to be down at the bottom of the tier versus someone putting a minimal amount down.
I want to talk about a couple of programs here, and I want you to speak to those, and particularly the Chenoa Program and then the LIPA and MIPA programs that are part of Los Angeles County. Can you speak to those for us for a second?
Sure, definitely. So what happens with, there's I guess a couple different options when it comes to down payment assistance program, first time homebuyer programs. The difference is any of these programs, or some are available to people who are only first-time homebuyer first-time homebuyers. There's other programs that are available to people who you may have owned a property, but you don't currently own a property. And what qualifies you as a first-time homebuyer is that you have not owned a house in the last 3 years. So in the city of Los Angeles in particular, there's something called a LIPA, which is low income program assistance. What happens with that program is we, as a lender, if you're approved, you go through the standard pre-approval process. So we meet with the borrower, look at the income, we look at the debt, we assess how much home you qualify for. So in a nutshell, if you qualify for a $400,000 house, you can afford the payment, then we say, okay, $400,000, you need $12,000 for your down payment plus closing costs, which average anywhere from about 2 to 3% here in Los Angeles. And borrower might say, you know what? Yes, that payment is good. I only have $5,000 saved. What can you do for me? Well, if a property is located within the city of Los Angeles, and keep in mind, the city of Los Angeles is large, anywhere LAPD
Yes.
covers. So it could be as far south as San Pedro, it could be Canoga Park to the north. And east-west, it varies. If the property is a single family home or a townhouse condo, no multi-unit property, you may be eligible. Well, let me back up, I'm sorry. There are income limits based on the number of people that will be living in the household. So you have to be a first-time home buyer, not have owned a house in the last 3 years. You have to meet the income limits, and those income limits are published, which we can review at a later date. But depending on the number of people that are in your household, we look at the total household income. So hypothetically, if there's 7 people in your household, we're going to look at everyone over the age of 18 that is income earning. So even if your college age child is not going to be on the loan, we're going to look at their income that is factored into it. And if you qualify for that, then we can go to the next step and apply for the LIPA program. The LIPA program offers assistance up to $90,000 towards your down payment, closing costs, and something called
Wait a minute. Sorry. Say that one more time, because that might have snuck across people. What is that limit? How much is it?
It's up to $90,000.
How much?
90. So what happens with that is if you
Okay,
found
you got.
in, you know, in let me actually say the house you want is 400,000, but you only qualify for 350. What happens is you do have to invest up to 1.5%, or let me see, half of the minimum down payment requirement. So if the program that you're purchasing the house is conventional loan and it requires a 3% payment, you are required to come out of pocket with at least 1.5%. So on that $400,000 purchase price, you'd have to come out the pocket at least $6,000. Then what happens is that $90,000 is broken up to come up with the remainder of that 1.5% you're down. It's also going to cover your closing costs, and then gap. So we have a gap of $50,000. We have a gap from $400,000 purchase price to what you qualify for at 350. So 50,000 plus that 6,000 you need, plus closing costs, which say are 12, 13,000. That gets you to about $65,000. And I'm just doing math at the top of my head. So you may not need the full 90,000, but you're eligible up to that amount. So it's covering a few different things. The city of LA also has a program, moderate. So if your income limit is above that LIPA portion, it's a moderate income level as well. And that amount, instead of $90,000, it can be $30,000 or $60,000 in assistance. Now, I want everyone to understand that this money is available on a first come, first served basis. So you do have to get pre-approved. The property, again, has to be located within the city of Los Angeles. Once your offer is accepted, the city of Los Angeles will send an inspector to the property to make sure it meets the criteria in terms of the condition of the property. It doesn't have to be perfect new construction, but they just want to make sure most health and safety issues are taken care of. The other thing, what I want everyone to understand is, with that purchase, you are still responsible for the mortgage payment on that $350,000 purchase price. The amount you qualify for. That's what you're making the payment on. The assistance that you're giving, whether it's $65,000 up to $90,000, that assistance is something called a silent second. So you will have a lien on your property for that particular dollar amount that you have from the city. That amount there is not forgivable. You do have to pay the money back. But what happens is they allow you to pay it off once after 30 years. If you've never touched that first loan, you then would pay it back once that is owed. Once the 30 years pay it off, then you would pay off the silent second. Now, if at year 10 you decide to refinance your home and get cash out, or you want some equity, the city would require you to pay that money back. If you do sell the property in between, 5 years from now, there's something called shared equity. So you'll be paying that money back plus some. It is a great program for buyers to be able to purchase a little bit more than what they might qualify for off the top. When it comes to the Chenoa program, Chenoa is just one other. It's not gap financing like the city of Los Angeles. It is a down payment assistance program. There's multiple levels to it, but kind of in a nutshell, what it does is it allows a borrower to primarily get into the property with no money down. So in my examples before, where I mentioned you have to have 3% or 3.5%, I'll give you an FHA Chenoa example. You are able to purchase your down payment of 3.5% will come in the form of a loan as a second loan. And what happens is you would still come in with your closing costs, or, as a realtor, Deidre can help write an offer, try to get some assistance if possible, but you should be prepared to at least pay your closing costs. With the Chenoa program, depending on where your income level is and the county that we're purchasing in, you may be eligible to get a forgivable second or one that's due in 10 or 30 years. Now, the forgivable second option is set up where if you are, again, in LA County with a certain, I believe the income limit is, I'm looking at my notes, it has an income limit in the $60,000 range. It's basically with the city, the county of Los Angeles, or every county produces their EMI, their median income. So depending on the county you're looking to purchase, if you fall below that, then you could be eligible for that forgivable second. You must make payments for 36 months on time. And after that 36 a month, then you would be eligible for it to be forgiven. Now, if you don't qualify for that, if you still have, your income is above that, you still can get the assistance with the down payment, and it can be paid back over a 10-year period or a 30-year period. Now, with the Chenoa program, their first mortgage comes with their own set of interest rates. So it's not the market interest rate. You will be paying anywhere from about 3/4 to 1% higher than what market rate is. But keep in mind, this program is helping you get in the door of purchasing a home. So you have to kind of weigh the pros and the cons of doing that. It's not for everybody. You will have to have a minimum score of 620 if you qualify for the forgivable second option, or a FICO score of 640 if you are above and you're doing the repayment option. All these programs I'm telling you about have to be a property that you're going to occupy. It has to be owner occupied. It is not eligible for any type of investment property that you're looking at. You may also have to do home buyer education, 8 hours, just to kind of understand. You go through a very in-depth process of what it is to become a homeowner. And again, the programs are here to help you get your foot in the door. We know here in Southern California, it's a very desirable area. People, you may make the money, but it's a hard time saving it. If you have to rent and pay $2,500, $3,500 in rent, it's very hard to come up with that down payment. And day after day, I hear from people saying, but I can afford the payment, I qualify for more. Yes, that's true, but you have to, the way we calculate things, we're calculating based on where your current income is, where your current debt is. So these programs help for those that need to help with saving. The Chenoa program, you don't have to be a first-time home buyer. You just can't own a property at that particular time. There's a couple other programs. Again, once, the way most lenders look at it is we collect the documents from you. We kind of assess what your need is after we talk and we interview, and what your desire is. If your desire is not to live in Los Angeles County or Los Angeles City, we wouldn't even discuss the LIPA program. We would look at another program. So we have, a variety of options, and it's just a matter of finding what, fits the puzzle piece that you need.
What would be the ins and outs of the adjustable rate mortgage, or the ARM that I'm speaking to? For some of you out there, you have no idea. When I said ARM, you thought I was really talking about ARM. It's adjustable rate mortgage. It's an acronym. So Toni, can you talk about those three?
So what happens is, the 30-year and fixed year are basically the terms of how long a mortgage is repaid, the time period of mortgage is repaid. So they're as short as 10 years, 15 years, 20 years, and 30, which 30 being the most common. There are lenders out there that will do a customizable, 28 or 25, they'll get creative, but the most part, it's standard 30-15. You're basically financing the same amount of money over that period of time, but when you can, same amount on either loan, but when you're condensing the period that you're paying it over, your mortgage payment is going to increase, may not double, but it's going to increase because you're paying it in a quicker time. The interest rates will vary on each one. You have fixed rate mortgages, meaning that your mortgage payment is virtually going to be, the principal and interest payment are going to be the same from day one to month 358. What will, the only thing that will be changing is, again, if you have mortgage insurance, there may be a point where the mortgage insurance drops off. If you impound your taxes and insurance, that has nothing to do with your principal and interest. It would just maybe modify if you increase your policy or you change something, your taxes changes, but your principal and interest would remain the same for the entire term. The way I pretty much advise borrowers, if you're a person, depending on what your goals are, if you're just starting off with a family, you're just buying a house for the first time, definitely a 30-year mortgage is what you want because you are spreading it over. Now, if a person says, I have a different goal, I'm planning on retiring in the next 10 years or 15 years, and they want to be aggressive, they want to be debt-free, or they want something to change in a shorter period of time, then a 15-year might be what works best for them. So it all depends on what exactly that person's goals are. Now, when it comes to adjustable rate mortgages come in a myriad of ways. You can get an adjustable rate that's going to fluctuate, over a short period of time, or you could get what we call hybrid ARMs. Hybrid would mean it's fixed for 5 years and then it becomes an adjustable, or it's fixed for 7 years and it's adjustable. And so really it boils down to a person's preference. I don't necessarily recommend an ARM in this day and age because interest rates are so low. And when people hear it all the time, they're low, low, low. Well, what is low? You're depending on credit, depending on everything, you're easily in the threes. We've had people lock in below 3%, which is unheard of. And again, I use myself as an example. When I purchased my home almost 20 years ago, we were at 8%. I know my parents purchased their home, they were 13%, and this is back in the 80s. So if you think about what interest rates were and where they are now, I just don't see a lot of value in a person going to an adjustable rate because, we don't know what the future holds. We don't know what even when it comes to locking in loans, we don't know what's going to happen next week. So I just highly recommend a fixed rate mortgage for most borrowers. And when it comes and also when it comes to a fixed rate mortgage, you always have the opportunity to pay extra or pay more on your principal. So just because you have a 30-year mortgage doesn't mean you have to wait and pay 1 month at a time. You can always apply extra each month if you choose to.
So Toni, I want to say thank you once again for taking time out of your day. Let the people know how they can reach you.
Thanks again. I really enjoyed this. This was great. If you're ready to apply, you can go ahead and apply at www.tonicarter.net and definitely put Dietrich's name in the box so we all connect and we can get you an escrow.
Awesome. Well, thank you again, Toni. I want to thank you all for watching this edition of Info on the Go. I hope you found this information useful. Please make sure you subscribe to the channel, ring that bell so you're notified when I upload future editions to YouTube. And as always, I will see you next time.